Welcome to PM Express Business Edition. And some banks have started releasing their 2022 financial results, and it doesn't look that good. Well, some have blamed it on the impact of the domestic debt exchange program, and that's why we are seeing these numbers. But is it the end, or there are still more challenging times to come? How do these banks get out of this challenge? Is it over, or there are still some challenging times ahead? Well, for such a program, we need to get the chief executive of the Ghana Association of Banks, Mr. John Ewaz, join me in studio here. And I appreciate your time so much. As we try to find out whether or how can the banks recover from this current challenge. This is PM Express Business. Mr. Ewaz, I appreciate your time so much for having time to join us in quite an interesting time. Interesting time to be a banker, some would say.
I think you'll not be far from right here. Yeah. If you say that, yeah.
And how are you doing personally? I mean, looking at trying to keep the association together, trying to convince depositors that it is still the safest sector to place your funds. How has it been for you personally? And now that the numbers are also coming up.
Yeah. You know, the financial system is not just the banks. We have other players within the system, and we control a certain portion of the sector. For all intents and purposes, the banking system or the banking sector is the largest within the financial services industry. So to that extent, it's been quite a journey in the last couple of weeks, I would say months, since December all the way to this time. It's been quite challenging, but we are where we are. We have not heard of any kind of hiccups here and there where customers are queuing in the bank, or there's nothing close to that. So to that extent, I'm extremely excited that we are where we are now, and banks are operating as business as usual.
The numbers do not look that good, and I'm convinced about the assurance that you're giving to us. But the numbers don't look good. I mean, for some banks, for the first time in history, and I stand to be educated, they are posting losses.
Of course, once we subscribed to the debt exchange, and we subscribe to a debt exchange under certain kind of mechanics. Of course, we understood right from the get-go at that time that there was going to be some form of impact on the industry. So the numbers that have come out, save for any after audit adjustments and the like, has been exactly what, as an industry, together with the central bank, we've been expecting through our own internal calibration of the impact. So yes, to you, it's very shocking, but we have seen this impact all the way from the time that the exchange memorandum documents were signed.
Some will say that whichever way you want to look at this, and again, speaking from the layman, this is a bad debt exchange program, and it's telling on your numbers. It's a terrible one. Why did you accept it?
Yeah, of course, yes. You don't have to look at it from that unidirectional level. You need to look at it from the broader level. What if there was no debt exchange? Have you asked yourself, potentially, where would the country have been? So we have to look at it from both sides. Of course, it's been a very difficult decision for the banks. I dare say that I'm sure for some of the MDs of the banks, it will be, about some of the most difficult decisions they've had to take in their careers. Taking something like a debt exchange, maybe support documentation to your board to make a justification why you think it is appropriate or okay for your board to give you the mandate to subscribe. So it's not child's play. It's been a very difficult decision. But the banks took a strategic position. Whereas, of course, there were hula baloos here and there, we took a stage, or we took the position that, as a financial system, certainty and some form of stability was extremely important. Are we going to sacrifice stability on the altar of, pushing and pushing and pushing and pushing, and to get what? And if you get to that level where you've pushed the dates from December to January to February to March to April, and the economy is tanking and tanking and tanking, you operate within the economy. And if the uncertainty results in significant disruption in economic performance, of course, then you'll be holding instruments that you call bonds, but will be more or less worthless. That is why we took the position as an industry that we want to be part of the solution, and therefore, how do we work with the managers of the economy in a manner that, whilst it's unpalatable, we can also put in some form of protective mechanisms for the bondholders and also fight for a deal that works in some respect, that works for the industry. So you can see that clearly from the first exchange memorandum document to the third one is almost a complete departure from 4 bonds to 12 bonds, from 0 coupon all the way to 1 coupon rate. So all those things.
Could you have pushed further? Because some are saying that I look at the numbers and I look at the impact. I mean, this is not as a result of any of your banks' bad banking practices, bad investment, that has put you guys in this situation.
Yeah.
I mean, the losses. Could you have pushed further for a better deal? Because you had not brought this situation on yourself as commercial banks. Why didn't you push for a better deal?
That recognition is not lost on us at all. We did push.
But maybe that push was not good enough.
No, it was. I mean, actually, for them to concede, if you read the exchange memorandum, to see certain kind of clauses that we ensured that were embedded within the new, particularly the final memorandum documents, it will be a bit unfair to the negotiators if you say that we did not push it down. We did push. I would say countless number of meetings, letters exchanging. These are not things in the public domain. They are not things that you organize press conferences on, because this the environment is
forced on your neck from the regulator, Ministry of Finance.
No,
the regulator whip you into line. You have to accept these deals.
No.
Or there is no way forward coming from the regulator.
In the end, right from the beginning, it was clear that it was a voluntary program. So none
of your members were whipped into line.
Nobody can whip anybody.
By the Bank of Ghana.
The banks are autonomous. They are regulated by Bank of Ghana, but Bank of Ghana does not take decisions for the banks. I think that point must be made very clear. That the banks are very autonomous. Even the association cannot compel any bank to take a decision whether to accept or not to accept. These are individual bank decisions. So long as the overall framework was agreed, banks then had to go through their own internal governance processes to ensure that they do the right thing, governance-wise, and also to be consistent with what we all had agreed to pursue.
Let's again come to youth financials, and since you are representing the association, I don't want to be specific on any of these banks, but I know that in previous engagement, even today, you sought to assure the public that everything is safe. I mean, again, I still want to position myself as a layman here. Looking at profits, looking at financials, they have an impact on reinvestment and growing the business and all the rest. So I struggle to understand when the P&L account is terrible, but you are convincing me that solvency and liquidity is intact. Help me out for that man on the street who is saved with the Bank A, and he's still struggling to be convinced by you that when it comes to solvency and liquidity is intact, despite those bad numbers that you positioned.
Let me tell you one thing, and here I'll use a personal story. Many years ago, in my early careers, I worked for a bank. This is years ago. That bank, through some internal problems, recorded the worst ever loss at the time, and was the least performing bank in terms of profitability. Big loss. 3 years down the line, that bank was the #1 performing bank in terms of profitability. It tells you that profits or loss can be situational, and you need to look at the context around that profit or loss. So you clearly, if you look at the results that have been posted by the banks, and you mark forward just 3 months after those results, all the banks that have posted these kind of results have also, because of the fact that the unaudited Q1 results have coincided with the publication of the 2022 financials, the banks that posted those negative or losses that you referred to have all turned the corner already. In fact, all of them.
Help me out, because how is it the application of the accounting rules that sum was reviewed this year. That is why we are seeing this quick turnaround, because again, some are struggling to understand that.
Yes, of course. You know, during the discussion stage when we started talking about the implication, particularly the accounting implication, at that time, I'm not sure note was really taken by the business community, including people like yourself, media people. Yes, the losses that the banks recorded, or some of the banks recorded for the 2022 financial year, were mostly due to the impairment losses occasioned by the accounting treatment under the debt exchange. So these were not underlying performance losses. They came about because the bank had signed on to a program, or they were going to sign. The government had indicated its intention that it may struggle to service its obligations under the old bonds. Yeah. The accounting standards tells you that if you anticipate losses, you need to make provision for it. Yeah. So we call it expected credit loss. Yeah. And it is that expected credit loss that resulted in the results that we had for December 2022. Now, the old bonds have been de-recognized from the books in 2023. The new bonds have been, recognized, though recognized impaired. Of course, the characteristics or the price mechanisms around the old bonds and the new bonds are completely different. So some of the losses that we took in December have started unwinding because of the current market fundamentals. Interesting.
Because I was expecting that to impact on your investment in terms of these long-dated bonds and short-dated bonds. But how, and again, I struggle to put myself in an informed person and again put myself across as a lay person on the street, that these should have just impacted on your investments.
No. I mean, when you make an impairment adjustment, when you are making the impairment, it's going to your P&L. Yeah. If the impairment is unwinding, it has to go back to where it went to.
Yeah. But these things, some will say that it might just be the first stage of the expected shocks on the industry, and therefore, I am still not convinced that because Q1 numbers are good, we are turning the corner.
I believe that the underlying, you need to look at the top line revenue growth, look at the deposit numbers, look at all the other, don't just look at the impairment line. The impairment is a provision. You understand? Yeah. Look at the revenue growth.
You expect them to go bad.
Which one is?
The impairment.
No, not necessarily. Of course, the credit environment is not, the economy generally is not at its best. The credit situation and performance of businesses are not at optimal levels. So we expect that there will be heightened impairment risks in the horizon in 2023. That is more or less...
Purely to say the layman said these credits will be difficult for it to be settled, right?
Not to say that debts will not be paid, but...
On time, when it comes to the accounting principle.
Which accounting principle?
When it comes to servicing of these debts, there are timelines that these debts...
So the debts that occasioned the impairments that we are talking about is the government bonds.
Okay.
Those government bonds are now under the debt program.
Lines. Okay, sorry.
And therefore this program is locked and sealed. And government has a duty to perform on them. So we do not expect any additional losses occasioned by the bonds under the program.
To be written
except for not for us. Even in bad and worst case, we did not have a situation where we had to write off a stock, the debt, the bond stock. What we did was basically to do the expected credit loss assessment and took the impairment as was expected by the standards.
I'm still talking about the shocks here. What will be the impact of this on lending? Obviously, lending will be impacted, and that's a fact. Credit extension will be impacted.
It's both ways. Again,
that's the reality, some will say.
No, but you need to look at it in totality. The environment, of course, may not be very good for aggressive lending.
Where aggressive is?
I mean, where, businesses are freely offering loans, and because you need to really look at the credit environment. What is the effective demand in the system? We just had reports that the ports, there's even, of course, there's a slowdown in importation, which means that perhaps it is occasioned by the lack of demand, and because people's disposable incomes have been wiped off by inflation and other price adjustments. So it is possible that the demand for even the loans may not be there per se. But because the avenues for the liquidity is also now narrowed, there is no free way of just buying government bonds anymore. Banks will be looking to doing proper lending, to be doing lending to productive sectors, business professionals, households, who present bankable projects.
Is that
because the liquidity is there?
We've heard this before. Whilst you want to blame this challenge on the debt exchange program, some will say some of the commercial banks have been purely lazy. And I knew a bank that was just buying government bonds and was being turned out as a profitable bank. Banks are pushing everything because it's the safest. Listen, we've had an era where we enjoyed so much of high interest returns on government securities, and every bank was pushing it instead of doing real banking.
I'm sure you looked at the Bank of Ghana report. Credit growth, even in these difficult times, credit to private sector increased by 28.5%.
That's percentage. Sometimes some will say the real value.
No, but the real value is moving from a certain number to 67 billion.
But some of your banks, your members agree that they were not doing real banking.
It's not that we were not doing real banking.
Just investing in government bonds.
When it comes to lending,
and therefore you expose yourself so much to government. And that is why you had this challenge.
When it comes to credit creation, it takes two parties to play ball. It takes the borrower and it takes the lender. If there is no effective demand for loans, of course, where else would you put the money? Would you put in the vault?
Some businesses out there would challenge you on that. The MD of the Ghana Stock Exchange recently in the public event said that they were trying to get a deal from a bank. Even the Ghana Stock Exchange, the rate given to them was so high. There are lots of AGI business barometer. A lot of businesses out there present bankable projects, everything. A bank XYZ prefer to buy government bonds because it is a cheapest way of making cheap money.
I do not think that is the situation. And when people say we applied for a facility and Ghana Stock Exchange, let's forget about Ghana Stock Exchange.
And that is Ghana Stock Exchange?
No, you forget about Ghana Stock Exchange.
I said,
let's not use even real businesses. But when people say this, you need to ask the banks, how many loans have you given? You see, I've said this on your platform before, that if a bank, 20 people apply for loan, and 18 of the 20 get the facility, the 18 will not come on air and say, well, we have taken loan, we are very excited. But the two who don't, you hear from them. So the fact that you hear these stories do not really necessarily mean that banks are not lending, but of course, we are careful. The environment is not very, very, should I say, conducive and stable for you to aggressively be throwing money out there. But for bankable projects, banks are aggressively, and Bank of Ghana's report attests to that. 28.5% growth in lending. This is on gross basis, growth to new lending to business community. I think in these times, it is something that is really...
Sorry, I don't have the numbers here, but let's compare your investment in government securities, i.e. lending. What are the numbers saying now?
That
is why some are arguing that the banks have brought this challenge on themselves because they were doing lazy banking.
I will not subscribe to that. Why I wouldn't subscribe to that is you need to also look at what is the alternative. We are in a country or an economy where non-performing loan ratio is somewhere, over the roof. For every 100 Ghana cedis you give out, you are likely to lose 15 Ghana cedis of it. When the depositor brings 600 Ghana cedis to you, he is coming to pick 100 cedis plus interest. So you, the banker, you have a duty to ensure that you have the capacity to return depositors' money when they fall due. So it's a balancing act. There is no hard and fast rule around how much of it should go here, how much of it should go there. But of course, you need to balance your portfolio in a manner that you do not unduly, place your bank at a risk of portfolio imbalances. So
going forward, are we going to see the real banking from your members going forward?
I don't know what you call real banking.
But are we going to see your credit decisions, your lending investment going to change? Because again, the debt exchange program what has happened to the industry just over the past 6 months has shown us that when we're in a cons class or the finance class, we're being told that government securities are the safest, because at that time, the economists and the finance people thought that government can print money. That theory has been defeated today.
It's been challenged.
And therefore, well, debatable.
Yeah.
Going forward, are we going to see things change when it comes to banking, investment, and lending?
Yeah, you see, let's look at the system in the right way. When you say banks are going to do proper lending, banks are not going to relax lending covenants. No. We have shareholders' interest to protect, depositors' funds to protect, and also to demonstrate to our stakeholders, correspondent banks, the regulators, that of course we will operate, we will be lending, but we'll be careful in lending. Being careful in lending does not mean that if there's a good deal or a good transaction on the table, a bank will not do it. Banks are actively in the market looking for deals. So you tell me a businessman who has a very juicy, nice a transaction that a bank is saying no, because banks have liquidity. I can tell you there is adequate liquidity in the system, and that liquidity is looking for homes. And those homes are bankable projects that banks are looking for.
And those projects will not go into government bonds going forward?
Of course, the avenue for the government bonds will not be with us for some time.
But I'm still trying to get this from you, that so going forward, forget about my expression of real banking. Are things going to change in terms of the investment decisions that will guide an escrow, and then also investment decisions when it comes to lending, that we are now going to see more prudent lending? As long as a Wiafe has a good project, a bankable project, you've met all the tick box, we'll be doing more lending to businesses.
I'm sure, given what we have gone through in recent months, of course, the boardrooms of banks will be taking a second look at their asset allocations. That is not to say that there's going to be prescription from anybody on how banks are supposed to allocate their assets. But of course, I'm sure there's going to be some very difficult discussions in the boardrooms of banks around how much of your assets should go into what asset class and for how long, and what the duration and what interest rate regime and the like. But again, you talked about the lending rate and the fact that it is up there.
Yeah.
You know, I've said it again.
It's an economic decision.
Yeah,
right?
the lending rate is not like a curtain that you go and raise it and lower it, you know, at will. You know, no, that is not how it works. The rate itself is a derived rate. Yeah. So it's market fundamentals that drive the lending rate.
We will cite the economy as a major factor, but some would also blame it on your credit committees and the kind of work they do before they lend this money. Why should I'm saying that, why should a Wiafe be taking the burden of a bank B decision not to do a prudent work on a business or a lender, that I am being charged for that non-payment of that credit?
But if a Wiafe goes to the bank to...
And I'm credit worthy.
That is you saying it.
Yeah.
Yeah, that's you saying it. But what banks are going through, particularly in credit sanctioning, or credit decisions, is, you know, sometimes you need to, you know, even dig more deeper to be able to unravel some of the things that customers seek sometimes to hide from banks. If you were in the environment of credit decision making,
you start a lot of escrow committees.
I'm telling you, you would see how customers can also mislead. Not that the banks do not do the due diligence. If a customer is bent on also hiding something from a banker, I'm telling you, it's very difficult to fish it out. You can ask all the nice questions, tick all the boxes. If this guy is not a credible guy and is masquerading as a Wiafe, you will do lending today and take impairment tomorrow. And our systems are not fortified enough to also assist us when something like that goes bad. Our recovery mechanisms have been weakened because of the judicial system and how it accommodates distressed borrowers who use the judicial system to play the banks. It takes about 3-4 years to get a decision in the court system, lands commission, documentation. But the banks are going through a lot of problems that you cannot sit here and simplify. you know, because there's a debt exchange and the performance is...
But despite all these problems, some of these banks were putting over 400 million profits.
I mean, you ask yourself, what are the capital levels of these banks?
Yeah.
Tell me which industry has that the level of capital that the banks are expected to keep.
Because of your exposure and the kind of business you do.
Yes, and that is why whoever gives you that capital expects a return.
Yeah.
The average return on equity, before this debt exchange, for the banking system was about 20%. 20% at that time, some of the bonds were even had coupons above 20%, which means that a shareholder in a bank in Ghana at that time was even better off deciding that I will use my money to do something else. So it's not like banks are unduly profitable, but because of the size of capital that they are expected to keep in order to keep the machinery of banking going, it is expected that that capital must work to generate money for the holders or owners of that capital. It goes without saying, just like
I'm laughing.
Of course, yes. It's a risk and return.
Debatable issues.
No, they are not debatable. If you look at the financials of the banks, even in these difficult times, look at the equity line of the banks. There are banks that, if not for this thing that happened, where they had equity in excess of 2 billion, 1.5 billion, 1.5 billion. What return would you give to the shareholder who is keeping that money in the bank? Don't look at the quantum profits. Look at the amount of money that has been invested. And you will find and look around and you see that there are other businesses that are returning to their equity holders in excess of 40%. And nobody is talking about that. But banks are returning 20%. And hey, there's a problem.
I was talking to one banker and he was talking about the fact that, listen, George, things are going to change. I mean, when it comes to sponsorship, employment decisions and all the rest, some are saying that the shocks that we've seen with these financials is just a first layer of the expected shocks that we're going to see, i.e. on operations of banks, i.e. on sponsorship, i.e. on human resource. This is just the first layer.
Of course, I'm sure banks will be taking a hard look at their numbers.
Very tough decisions they will take.
It goes without saying that there will be, if your top line, we used to earn 20% on the bond portfolio. Now you are earning 9%. Already there is a gap in your earning, capacity. What it means is that you need to find ways of ensuring that your bottom line does not unduly suffer. So you'll be looking hard at what other things can we control.
If human resource would be the first thing on the top line. Some would say that is the reality.
No, I can't.
I mean, I know some banks who are doing some rationalization, but that has been kept under the bridge.
I would have known. Yeah. I'm not aware of that.
But obviously, human resource
to do those kind of
going forward.
Significant rationalization, you need the consent of the central bank, and I'm not sure that central bank has received any kind of.
So we should go to sleep that because of the expected shocks of the domestic exchange program. Let me use the layman and stop these technical jargons that some people will be laid off, or there'll be some re-rationalized.
You can't say anything for sure on people. No bank has come out to say we are taking action on rationalization. No bank.
And it will not happen. That's something I should take from you.
I don't take those decisions.
Yes, so but I'm saying that looking forward, it will not happen.
I can't speak for the bank, but I can only say what has happened since the debt exchange. I've been in several meetings with all these MDs. I've been in meetings with Bank of Ghana. We've had all these discussions. At no point have we gotten to the point where a bank has said, we are bringing a proposal to maybe undertake rationalization.
So a bank making over 300 million loss of 400 million, obviously, personnel going forward will be affected.
I'm saying banks will take a hard look at their numbers. Those decisions relies in the bosom of the banks. So, the banks and their boards who will go through the processes to see whether, under the circumstances, further work is needed on people, further work is needed on their other operational costs, further work is needed on branch rationalization. Those are bank-specific decisions. Bank A may decide to close branch A or branch B. Another bank may decide to open new branches. This year, I've seen some banks open new branches. And this is after debt exchange.
Just kill one?
No, I'm sure.
Or these were decisions that were
I'm sure they were in the pipeline.
It's just about deploying.
But one would say if it was going to be that bad, then we could immediately take decision to say we are no longer opening it. You understand? So if banks are still kind of out there doing business, and again, no customer has walked to a bank and has been told, oh, please go and come tomorrow. We've operated seamlessly. There has been no noise. At no point during all this process and all the hiccups in the environment and all the discussions, the debates, the picketing and all those things, at no point did any bank suffer any kind of customers queuing or staying there. I want this. No way. Because we met the demands of our customers. And to date, we've not had.
Interesting. Yeah. I'll be coming back to you to get some understanding of whether the banks do not need any fresh capital injection, liquidity support going in terms of going forward, and also the fact that there are talks about recapitalization. Is it really needed now or not? This is PM Express Business Edition to look at the domestic debt exchange program and how can the banks recover from the shocks. We take a break and we'll be right back. Welcome back to PM Express Business Edition. After the shocks of domestic debt exchange program, how do these banks recover strongly to ensure that they become the safest sector when it comes to deposit, investment, and grow the sector because of the strategic role that they play in this economy? And Mr. Wah is Chief Executive of the Ghana Association of Banks, and he's here with me in studio as we talk about development in the banking sector. Now, I get from you that liquidity, solvency, and everything is safe. Does it mean that recapitalization, there's talks about recapitalization, is it 20 or 25 or 26? I stand to be corrected a little bit. Where are the discussions going in this line?
Yeah, it's not a recapitalization per se. We've not received any hint from the central bank they're going to increase the minimum regulatory capital. But what they have said is, if as a result of this debt exchange, you have a capital shortfall, you'll be given a certain number of years to build up the capital or bring in new capital.
What's the number of years are we talking about here?
Yeah, we're talking about 3 years.
3 years. Someone would say, is it fair to again even talk about recapitalization because majority of these banks that have found themselves in this position was not because of us?
It's actually a regulatory relief because technically once you fall below the minimum capital requirement, you are expected to immediately reinstate back to the minimum. So it's a recognition of the fact that the banks have really taken pains to more or less help the country to go through some difficult period. And it is not during this period that you also force, new capital on the bank. And actually, the terrain is actually not very, should I say, conducive for capital coming into banks that have recorded these significant losses in 2022. So the regulator has given that regulatory relief to enable banks, take some time into the future to build back or to introduce new fresh capital, either from existing shareholders or new shareholders, or plow back from their earnings over the next 3 years.
This is a relief. Do you think that some of your members, are they more than the decision of we will go ahead of ourselves and bring in fresh capital to ensure that we are not hit by any unexpected situation?
A lot of the banks don't even need it in the first place. A lot of the banks are already significantly above the regulatory minimum. A few of the banks may have need for taking advantage of the regulatory relief.
So some will look at the current position of banks today and they will raise serious questions about, was there really, what has been the effect of this so-called banking sector cleanup? If it had happened or it was done well, what is the current state of banks today? Some are questioning the effectiveness of that cleanup, looking at the current shocks of this debt exchange program on the banks. Some are saying that.
Okay, I'm sure. Let's not make a mistake. The banks that we have now are not the banks that were cleaned.
Yeah, I mean it was clean, and then the banks were strong.
So the banks that we have now are the strong banks that remained, and that is why, in spite of the big hits that the industry has suffered, we still have the banks doing doing their business, which means that actually we had very resilient banks post the cleanup era. So the banks that we are dealing with presently are the banks that have the right capital levels, right liquidity levels, performance is at its best, until we enter the debt exchange. But of course, if you even go to the UK big banks or the US big banks, and they are holding this stock of bonds at a certain price, and all of a sudden, through a certain arrangement, about 50% of the revenue goes away, you have a blip. Nobody can, no kind of bank can withstand that kind of significant kind of drop in your earnings with its consequential accounting treatment on modification, losses, and the like. So, of course, the banks that have gone through and have already started turning the corner, I applaud them. Do
you think that any of your bank's members might need an immediate capital injection to ensure that things doesn't get out of hand? Some are saying that some of the banks might need immediate injection of capital.
If you are a bank and you are below the minimum, it is in your own interest.
Yeah. But there are some are saying that, yes, some have been able to absorb these shocks because of the buffers. Some had a thin buffer, and therefore the argument is that if there aren't any significant injection, these banks are on the edge.
I wouldn't put it that way, because the buffer will ensure that you are meeting the requirements under the Bank of Ghana regulations. But to enable you to do business, you need the right capital levels. If you are a bank, in order to do business, international trade, your correspondent banks will be looking at you with a certain eye. If your regulatory capital is below the regulator's minimum, though the regulator has given you a relief, that relief will not stop the correspondent bank from saying that because your minimum is below the minimum regulatory threshold, I'm no longer going to deal with you. So banks that fall or have fallen below the regulatory minimum, it will be in their own interest to quicken their pace to beef up. But of course, the reliefs exist for banks to also work their way towards meeting that regulatory minimum.
Talking about reliefs, and I remember the governor explained the other time that they have their own stability arrangement to deal with the banks apart from what government is working. As we speak right now, what is the discussion on the table in terms of the Ghana Stability Fund that Ministry of Finance is pushing to help the whole financial sector, and then what the Bank of Ghana says it has available to also support the banks? Because some are saying that this will come with some equity swap, and that's why some banks are not comfortable with that. Help me out, what is on the table as we speak right now?
On the Financial Stability Fund, I'm afraid is not in place yet. The framework, I'm told, has been finalized.
The minister talked about June or July or something.
Of course, we want to see the number on the table. And as far as we know, it's the World Bank that has made some commitment, and that commitment is going to be for solvency support. But it's a 1 billion fund, and we don't have it on the table as we speak. The central bank window for liquidity is an existing window. We have the repo window, and then we have the emergency liquidity assistance window. And what they have said is those windows are still open to banks in the event any bank has need for liquidity.
What do the banks have to give in for this support? Is it purely on a commercial business?
Yes, it's
or it comes with equity?
No, the central bank, no.
Like GATS and all the rest. And some are saying that because of all these things, some of the banks are really not that interested in it. Because
the fund is not in place for you to even begin talking about whether it's going to be an equity fund or a debt fund. It is not in place or is not available at the moment. The central bank window is for liquidity, the repo is for a very short term, and then the emergency liquidity assistance is for medium, or actually I'll call it medium term liquidity assistance. The central bank window doesn't come with any kind of discussions on equity. It is basically a repo. You may have to post some securities, and then they give you the liquidity. And now we have the securities, of course, those under the program. But there is the Financial Stability Fund, which is being put in place, where I'm sure there's going to be a fund for liquidity assistance and a fund for solvency in the unlikely event that there will be need for...
Judging from what we learned from how GATT went, I believe that there are some who might be worried about whether it will come in the form of an equity swap.
I cannot speak to it at the moment because the mechanics have not been made available to us.
You think it's a good thing that having these buffers there alone reinforces more confidence in the sector for you, because there's the Bank of Ghana liquidity provision, which the governor recently actually clarified, and then there's also the Ministry of Finance provision also there for banks that might need this.
Our preference was for the fund to have been in place even before we signed the exchange memorandum. Of course, that was our preference. But we are where we are. The exchange memorandums have been signed, the instruments have been exchanged, but the fund itself is not in place at the moment. The good thing is that it's not like it's tanked, but there's work ongoing to ensure that it is in place. And you were quoting the minister who said that by June.
July, sorry. The interview I had with him in Washington, he talked about July this year should take off here.
Yeah, we are also hopeful that it should be in place, not just in place, together with all the mechanics for accessing it should be available.
But I get from you that the banks are strong, liquidity.
At this moment, I mean, the central bank said it, for which reason they have even withdrawn some of the liquidity reliefs they gave us.
Do you think it's a good thing? Because some are saying that at this juncture, all these reliefs are needed to be in place to again reinforce confidence in the sector.
I mean, the concern the banks had was that the reliefs were given to us to enable us to sign the exchange documents. So if after signing the exchange documents, almost a few months afterwards, some of the reliefs are being rolled back, then, it sends a signal of, why then were we told that these reliefs were going to be in place? So it's a matter of principle that the banks are saying. It's not that the banks really need the liquidity, but they signed it based on a certain documentation. And those things, getting rolled back is a matter of concern to the industry. And that is why, some of them have expressed those kind of concerns to you.
Let's look at regulation in these current circumstances. Has regulation been that helpful? Or we still have the headmaster student thing where some will say that the regulator do this, that, and that. How has regulation been for you?
I think we have moved on quite well with the central bank on regulation and on supervision. A lot of the directives, notices that come out, before you see it as a media person, would have gone through a certain form of back and forth with us. Sometimes the draft is, not sometimes, now, all the time.
The draft are shared with the banks.
Yes, shared with us for our input. It goes back to the banking supervision, or depending on which department is coming out with the financial stability, financial markets, or banking. So it's evolving, but I would say that it has significantly improved. Are we where we would want to be? I'm not sure, but there's still some way to go in terms of regulator-regulated entity relationship. But I think we work very well with the central bank, and they are quite accommodating. We've had very fruitful discussions throughout this process. I cannot, if I had my notebook here, you would see the number of meetings that we had with the governor himself, with his deputies, and the finance minister, several meetings that no media, no cameras, no recording, that we've had
house rules
just to understand and make sure, these brainstorming meetings to ensure that what we are doing will serve the purpose. Because the overarching decision was that whatever we do, we should not sacrifice the financial system. The financial system should not at any point suffer significant damage because we have gone into a program to access IMF funding. And that is what we have done to date. And so far, I believe that we are on that trajectory. And if things go to plan, we should get out of this storm unscathed as an industry and then work our way back. They say if your life is very straight line, then there must be something wrong. Even in personal life, sometimes it's like that, different troughs. And it's your ability to bounce back which is more important.
We have seen, and again, sorry to backtrack a little bit, but I'll try and box this together. I said initially that I don't want this thing to be bank specific, but I've seen a bank that in this current challenge still was managed to survive the storm and has posted some handsome profit numbers. Again, what does it tell on the industry, some would say?
You mean 2022?
2022.
Of course, it's not all the banks.
So
It's the portfolio shift, portfolio balance. So it all depends on how much of your investment is in this tenor, that tenor, or how much of it is in. It all depends on so many factors. There are banks that have their exposures in the Eurobonds, which are yet to come. There are banks that have no exposures at all in the Eurobond. There are banks that, if you look at the balance sheet, the structure for each bank is a bit different. So they'll be hit in different ways. And that is why some may have some level of minimal impact than others.
So let me backtrack a little bit into a separate area, because you talked about the inputs in some of these directives. Recently, there was a financial stability circular that talked about the fact that loans where borrowers are not made to understand all the fine details, they should not honor these. How are the banks taking some of these circulars coming from the financial stability when they not get a deeper understanding of these conditions? They shouldn't honor these.
No, but if you read that circular, it was an advice to the public.
Yeah.
It was not to the banks.
Yeah.
It was not a directive to the banks.
Yeah.
It was advice to the borrowing public.
Yeah.
That the banks know they have to do this. They have to disclose this to you. So if you are taking a facility from a bank, ensure that you have been told, you have been given the APR, you have been given a document that gives you the terms of the facility that you signed to before the bank gives you. So it is not like the banks were not doing something, but it was more or less a public education to the borrowing public that if you enter into the business of borrowing from the banks, these are things that you should talk.
Mr. Wa, in a minute for you, how do we fast track the recovery to ensure that we get back the groove of the banking sector? In a minute.
The banks have taken a significant hit through this process. We did it because we have strong belief that with the IMF program, it will unlock other kind of funding sources to the country. We need to work our way back to economic prosperity quickly. We cannot suffer any kind of significant volatilities into the near term. And to that extent, we call on all the managers of the economy, the regulator, and also the banks, that we should all come to the table. We should come to the table in the best possible way, with our best efforts, because we have a country to build first. And also to you, the media people, that this is not the time to go on sensational media frenzy. We need to know that we have a financial system to protect. And so you can talk to the numbers. We are not saying no media should talk to the numbers. Talk to the numbers, but do not draw conclusions that the numbers are not saying.
30 seconds, quick one. Q1, are the numbers looking that good for all the banks?
Very good.
What's the profit, 30 seconds?
We are very good. Banks have turned around, and customers should feel free, walk to their banks, apply for the facilities they are looking for. If it is whatever channels they want, they should just talk to their bankers. The banks are ready.
Mr. Wa says, walk to your bank and talk to them. They will give you the facility. We'll go and hold the snake if it doesn't happen. This has been a PM Express Business Edition. Let the debate go on in your various homes and banks and even offices about how we can best help to recover our only banking sector. This is PM Express Business Edition. Have a great day.